Welcome back to What's Hot, What's Not. CRE, your daily pulse on commercial real estate in America. It's Wednesday, February 4th, 2026. Today we're tracking the 10-year Treasury and what it signals for CRE deal flow. All right, let's dive into what's hot. The big story today is actually a story of stability. The 10-year Treasury is sitting at 4.28% as of this morning. Yes, it's ticked up slightly, but what's really important is that it's holding steady, providing a level of predictability we haven't had in a while. This follows the Fed's decision at its January 28th meeting to hold rates steady in the 3.5 to 3.75% range. Remember, this came after 3 consecutive cuts in late 2025, and now the message from Fed Chair Powell is clear. The economy is on firm footing, and rates are currently appropriate. For the CRE market, that word, appropriate, is music to our ears. With the yield holding firm in that 4.25 to 4.30% range, the math is finally working again for buyers and sellers. We're seeing transaction velocity begin to pick up. Deals that were stalled are now finding common ground. And critically, cap rate spreads remain attractive. We're seeing an average spread of 2.29% over the 10-year, which is above the historical average of 2.15%. This healthy spread, combined with stable rates, is driving demand, particularly in the multifamily and industrial sectors. Now for what's not. While stability is good, the market's expectations have shifted. Just last month, the consensus was for 2 more rate cuts in 2026. Today, the market is pricing in just 1. That's a significant downgrade in dovish sentiment. We're also seeing some internal tension at the Fed. Governors Moran and Waller both dissented at the last meeting, arguing for another 25 basis point cut. This signals the debate inside the FOMC is far from over, creating a risk of an extended pause. The next meeting isn't until March 17th, and no cuts are expected until mid-year at the absolute earliest. This higher-for-longer reality is hitting floating-rate debt hard, especially those 2021 and 2022 vintage deals that are facing maturity walls without the relief they had anticipated. The pain is not spread evenly either. Office and retail are most exposed, showing about a 78 basis point cap rate movement for every 100 basis point Treasury move. Contrast that with industrial, which only sees about a 41 basis point sensitivity. That's a huge divergence in risk. So, why does all this matter? The key takeaway is that the 4.28% yield itself is workable. It's the stability at this level that unlocks deals, not necessarily the hope for a much lower number. But that narrative shift from 2 rate cuts down to 1 means patience is required. Lenders are cautiously re-engaging, but they're being incredibly selective. They're favoring stable, cash-flowing assets and shying away from transition stories. For those floating-rate borrowers who were just waiting for a wave of cuts to provide relief, well, they're finding themselves running out of runway. Fast. More than ever, this environment proves that sector selection is paramount. The difference between industrial's relative insulation and the high exposure of office and retail to rate swings is the defining story for portfolio managers right now. And that brings us to the investor takeaway. At a 4.28% Treasury, the math works for quality assets with strong fundamentals. But you must underwrite conservatively. Do not bank on future rate cuts to bail out your deal. Industrial and multifamily remain the most insulated from rate volatility, while office and retail carry the highest sensitivity risk. So for those of you with dry powder ready, opportunities are definitely emerging as this newfound stability takes hold. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.